Welcome. Today we are going to discuss about the comparison between the commodity exchange and stock exchange. The basic difference between the commodity exchange and the stock exchange is that while in commodity exchange, non-financial commodities such as agricultural products, castor, groundnut, sesame, etc. and non-agricultural products such as aluminium, zinc, nickel, coal, etc. are traded. However, in the stock exchange, all financial products are traded such as stocks, securities, indexes, interest rates, government securities, etc. Talking about the location of the markets, the commodities markets are usually located in the immediate vicinity of the production place, whereas stock markets are located in the large cities where large investors are able to meet in the market. Next, types of contracts. The commodities markets as well as stock market deals in n number of types of contracts, whereas in commodities market n number of transaction takes place in the spot contracts, whereas in the securities market most of the investors prefer futures contracts. Next, problem of storage. So in commodity market there is a requirement for a storage of commodities, whereas in securities market there is no question of any requirement of storage facilities. Taking about the listing part, in commodities market there is no requirement of any listing of commodities. On the other hand, in the stock exchange it is compulsion for every contract to be listed in the recognized stock exchanges. Looking on to the membership part, in a commodities market any trader who wishes to trade can become a member who is capable of fulfilling the basic requirements, but whereas in the stock market only a prescribed members who has fulfilled the prescribed eligibility criteria by the stock exchange can become a member of stock exchange. Next, talking about types of contracts in the commodities market. Generally, in the commodity market, we can find three types of contracts, namely the spot contract, physical trading, and derivatives markets. Firstly, let us understand what is a spot contract. So, a spot contract is an agreement wherein the delivery and payment either takes place immediately or within a short period of time. So, such a contract we call it as spot market. Next, moving on to the physical trading. So normally a physical trading involves a visual inspection and is carried out in a physical market such as farmers market. So in a physical trading, what happens? A trading happens in front of us and we are physically existed in the marketplace. Next, talking about derivatives market. Derivatives market on the other hand requires the existence of agreed standards so that trades can be made without the physical inspection. So in derivatives market we won't enter into the market or we won't possess any of the commodities, but we trade only on the existence of agreed standards about the commodities market. Now let us know about the types of transactions traded in the commodities marketplace. So this means which are the modes that the transactions are executed or mechanism followed by the traders in order to execute their trade transaction in the commodities market. Firstly, talking about spot contracts, the term spot refers to a transaction for immediate delivery. That means in a spot contract, if a buyer buys the commodity, then immediately the possession as well as the ownership comes to him. This involves the prompt exchange of good for money. In a spot trades almost always involves actual delivery of goods specified in the contracts, and in most of the cases in spot contracts are generally settled in a cash trades. Next, looking at the forward contracts. What is a forward contract? A forward contract is one that specifies the transfer of ownership of a commodity at a future date in time. This is opposite to the spot contracts, whereas in spot contracts we have studied that it is a marketplace where possession exchanges immediately, whereas in forward contracts it is just opposite to that specifies the transfer of ownership of commodity in the future date and time which is not today. For example, if today the buyer and seller agrees on a contract, but the actual ownership and possession transfer only after the actual contract takes place, that means the date mentioned in the contracts. Here no cash changes hands today, that means the monetary value for goods or commodities changes only on the day of contract, that is in the near future date. The forward contracts are not necessarily standardized, but they are dependent only on the consenting adults who choose whatever terms they want. Next, talking about futures contract. The future contracts are specific type of forward contracts itself. The future contracts are traded on organized exchanges. For example, Intercontinental Exchange ICE. This exchanges standardizes all the contracts terms, standardization facilities, centralized trading and market liquidity. Next, talking about the options. So what do you mean by option? Option is an facility where a trader possesses. Right? In option we have two types. That is call option and put option. In the call option, a trader has a right to buy, whereas in the put option, a trader is able to sell the commodity. If I buy an option, I buy the right, whereas if I sell an option, I give somebody else the right to make me do something. Options are beneficial to the buyer and costly to the seller. Next, what are commodity derivatives? Commodity derivatives are investment tools that allow investors to profit from certain items without possessing them. Thus, commodity derivatives are contracts where underlying assets are gold, silver, platinum, heating oil, natural gas, lead, steel, etc. Then, such a derivative is known as commodity derivative. Why the commodity derivatives are so much important? It is common knowledge that prices of commodities, metals, shares, and currencies fluctuate over time. The possibility of adverse price changes in future creates risk for business. Derivatives are used to reduce or eliminate price risk arising from unforeseen price changes. So, a derivative is a financial contract whose price depends on or it is derived from the price of another underlying asset. Now let us look at the why commodities derivatives are important. Firstly, India is among the top 5 producers of commodities in addition to being a major consumer of bullion and energy products. Next, agriculture contributes about 22% to the GDP of Indian economy. The possibility of adverse price changes in future creates risks for a business. So, to avoid all these unnecessary losses, one has to involve commodities derivatives. Next, talking about the types of commodity derivatives. In commodity derivatives, we have generally two types of commodity derivatives, that is commodity futures and commodity options. Firstly, talking about commodity futures. A commodity futures contract is an agreement for buying or selling a commodity for a predetermined delivery price at a specific future time. Futures are standardized contracts that are traded on organized futures exchange that ensure performance of the contracts and thus remove the default risk. Futures are standardized agreements between a buyer and seller to exchange a pre-agreed quantity of an asset of pre-specified quality at a specific price and at a pre-specified future date. If the underlying asset is a commodity, the futures are called commodity futures. Let us understand the concept of commodity futures with an simple example. Suppose a farmer is expecting his crop of wheat to be ready in 2 months' time but is worried that the price of wheat may decline in this period. So he feels that he is in a risk. To get out of his risk, he can enter into a futures contract to sell his crop in 2 months' time at a price predetermined now. In this way, the farmer is able to hedge his risk arising from a possible adverse change in the price of a commodity. Secondly, talking about commodity options contracts. So what is a commodity option contracts? Like futures, options are also financial instruments. They are used for hedging and speculation purposes. The commodity option holder has the right but not the obligation to buy or sell a specific quantity of commodity at a specified price on or before a specified date. Option contracts involve two parties. The seller of the option writes the option in favor of the buyer, so-called holder, who pays a certain premium to the seller as a price for option. So there are two types of commodity options. The first one, the call option, which gives the holder the right to buy a commodity at an agreed price, while a put option gives the holder the right to sell a commodity. The option holder will exercise the option only if it is beneficial to him, or else he will let the option lapse. Now let us understand the concept of commodity option contracts with an simple example. Suppose a farmer buys a put option to sell 100 quintals of wheat at a price of rupees 25 per quintal and pays a premium of rupees 0.5 per quintal. If the price of the wheat declines to say rupees 20 before expiry, the farmer will exercise his option and sell his wheat at an agreed price of rupees 25 per quintal. However, if the market price of the wheat increases, say rupees 30 per quintal, it would be advantageous for the farmer to sell it directly in the open market at the spot price rather than exercising his option to sell at rupees 25 per quintal. In this way, the farmer has the right to sell the commodity and not the obligation to sell the commodity. Classic commodity transactions are executed either in the spot market or in the futures market. So firstly, talking about the spot market. A spot market or cash market is a public financial market in which financial instruments or commodities are traded for immediate delivery. It contrasts with a future market in which delivery is due at a later date. In spot market, settlement happens in 2 working days. Therefore, delivery of cash and commodity must be done after the 2 working day of the trade date. Next, talking about futures market. Future markets are places to buy and sell futures contracts. There are several future exchanges. A future contract is a financial contract giving the buyer an obligation to purchase an asset and the seller an obligation to sell an asset at a set price in the future point of time. Lastly, talking about the common characteristics of futures and forward markets. Firstly, both future and forwards are firm and binding agreement to act as a later date. In most cases, this means exchanging an asset at a specific price sometime in the future. Secondly, both types of derivatives obligate the parties to make a contract to complete the transaction by engaging in another transaction that settles each party's obligation to the other. Physical settlement occurs when the actual underlying asset is delivered in exchange for the agreed upon price. Thirdly, both type of derivatives are considered leveraged instruments because of little or no cash outlay. An investor can profit from price movements in the underlying asset. Both the spot and future markets offer a convenient means of hedging or speculating. Lastly, both physical settlement and cash settlement option can be keyed to a wide variety of underlying assets, including commodities, short-term